Some interesting news out of the UK. Simon Smith is chief economist at FXPro. Simon, good to see you. Some headlines, really. Shocking headlines, if you will, I guess. UK inflation rate turning negative for the first time since 1960. What are the implications of that?
Well, naturally, for the first instance, it's certainly keeping on hold the interest rate outlook, certainly for the remainder of the year and into early 2016. We have to look at the core rate, which had been holding up quite well. Even 2 months ago, the core rate was at 1.4%. That's fallen dramatically. So now it's 0.8. It was at 1% the previous month. And that was the linchpin of which Bank of England was saying, look, you know, we're seeing low headline inflation, but don't worry, core inflation is still relatively firm, so there's nothing to worry about. And that story has changed. I think some of this could be unwound. A lot of it's around sort of air and transport fares that around the Easter period are quite volatile. I've noticed that before. So when we do see such sort of falls in year-on-year terms, we can see them reversed in the following month. But I think it is more worrisome for the Bank of England, and at a point certainly where rates are already zero, QE's been done, and you know, it was no QE's being potentially unwound in the US. So bottom line, it's certainly keeping rates on hold for the rest of the year and into early next year as well.
And typically it's much harder to deal with deflation than inflation, correct?
Exactly. There's always, you know, the theory is that you want a bit of inflation. It avoids the issues of falling prices, which, as you've seen of Japan, is naturally the recent example of that, where consumption is delayed, especially on sort of discretionary purchases. Well, I'll wait until things are cheaper in the following year. So, you know, and the sort of nominal wage rigidity argument as well. It's difficult for companies to sort of cut wages in nominal terms, so that creates issues as well. So going forward, yes, absolutely. You know, the Bank of England does have a headline inflation target, 2% plus or minus 1%. It's pinning on core inflation, you know, remaining relatively firm, and it's been a temporary phenomenon. But if it becomes more entrenched, then absolutely it does create issues for the bank and potentially more QE down the line.
Also out of Europe, we have news from the ECB today, and that is a stepping up expected now of bond purchases in May and June. So what is behind that decision, would you think?
If you look at the issuance of bonds by sort of governments and debt management agencies, it does normally tail off in July and August. Naturally, there's less investor demand, less people at their desks. So it's dealing with that seasonal flow. And also there's a tendency that governments do want to issue a lot earlier in the year and get issuance targets done. So I think it's a reflection of the fact that it's going to be difficult to buy bonds, number one, with the amount of liquidity. Generally, the market's falling in the summer period. Number two, with issuance also falling, which is something that happens every year from the debt management agencies. So I think it's probably to be expected. It wasn't announced along with the initial announcement of QE, but it's probably in terms of managing QE as a market-related program, it probably is a sensible move. But naturally, the fact it came out of one of the governing council members' mouths today was something that did knock the euro initially down one big figure. We also saw bond yields fall as well on the anticipation of, you know, greater demand in the near term.
Would you expect the euro to continue to fall, and where do you see the pound going?
The euro, short term, I would still see it moving lower, probably down to sort of 1.12 area initially. But in the bigger picture, I don't necessarily think that we're, you know, this dollar reversal is necessarily done yet. In the bigger picture, the Fed, I think, is still going to struggle to raise rates this year, and there's only so much the currency can get from the anticipation of raising rates. Sterling itself, short again, similar-ish picture. I think short term was sort of down 154, 153.50. As the rate outlook has certainly been, or rate hikes have certainly been pushed into next year. But still, I think we're going to hold above this 150 level for some time to come, again, because of the fact that I don't necessarily think the dollar reversal is done.
Simon Smith, thank you so much for your time.
Thank you.
I'm Rhonda Schaffler for TheStreet.